I'm Michael Thompson with Copperleaf Financial. I'm the partner and senior wealth advisor here for our team in Vermont. And today I'm super excited to welcome my guest, Jeffrey Levine. Jeffrey is the Chief Planning Officer at Buckingham Strategic Wealth and Buckingham Strategic Partners. And Jeffrey's been on board with Buckingham since 2020 now, I believe. But Jeffrey is a recognized speaker and financial planning expert across the country. Jeffrey is our go-to guy when it comes to new legislation and new rules around financial planning, around tax issues. Jeff is the first person that I look to and I go to for what the heck is going on, because I know I can always count on Jeff to read through that legislation and summarize it for us and help us understand what's the impact for our clients and what are the things we need to be thinking about. Jeff is a certified financial planner, a certified public accountant, a personal financial specialist, a certified wealth strategist, an accredited investment fiduciary, and I think it goes on and on and on. So Jeff is a wealth of knowledge. Thank you, everyone. A couple of tips ahead of our session today. First of all, thanks for joining us. We do record these sessions. We'll post them on our website in several days. And next week, we'll get them posted on the website. If you'd like us to send you a copy of the or a link to the video, please let us know. If you have friends you'd like us to share it with, we would be happy to do that. We will be taking questions today for myself or for Jeffrey. And please add your questions to either the Q&A or to the chat section down below. Our topic today is really planning for the second half of the year, planning for the end of the year, both from a tax standpoint and from a financial planning standpoint. And Jeff, I know when we set this up, we had just seen the passage of the Inflation Reduction Act, and we were thinking there might be some implications around that. But before we get started into this, I'm a naturally curious person, and I know that you've been doing this a long time and have gotten a tremendous recognition from your publications in Forbes and going online with Bob Powell and with CNBC and public television and things like that. I'm curious, how did you develop this expertise, Jeffrey, and how did you get to where you are today to be known as and recognized as the expert that you are?
Well, thank you. That's quite the introduction. My mother, if my mother was listening, she would fell right now. It's really interesting. I never intended to be in the financial planning business, and it's an extremely long, convoluted story of how I arrived here, but I'll give you the condensed version. Effectively, from the time I was 2 to the time I was like 21, I thought I'd be a doctor. I wanted to be a doctor. I wanted to help people. And as part of putting myself in a position where potentially I could go to medical school at some point, where I was going to school, I volunteered for the EMS group there and eventually became the chief of the organization, and was fortunate enough my senior year to be nominated for National Collegiate EMS Provider of the Year. And actually was even more fortunate to win. And the doctors who were in the emergency room where we would bring in people from time to time, they saw the news. I went to a smaller school in upstate New York, and the previous winners had all gone to like Texas A&M and Florida and Duke and large universities. So this was unusual. It got some local press, and they all were very kind to give me career advice and say, stay away from medicine. We like you. You seem like a nice kid. It used to be where we controlled what we did with patients and we could just do what was right for them. And now it's we tell the insurance company what we think, and the insurance company tells us what we can do to treat them. And that just seemed, it just seemed at odds with what I thought was the right thing to do. The thing I love about EMS is no one ever says like, stop, wait, before you give them CPR, check to see what insurance they have. Right. Do what's right.
Yeah.
And so ultimately, I decided I'd go a different route and didn't know what I would do. Now, the caveat to all this, or the thing that's also worth knowing is, I was fortunate. I wasn't born into a lot of money, but I was born into a lot of education. My mother, when my parents actually were getting divorced, my mother took a job initially really as a secretary for a local CPA at the time who just was trying to, needed staff in the office. It ended up that the local CPA turned himself into a nationally renowned accountant and specialist in the retirement account area. Many of the folks on this on with us today may have heard of Ed Slott. And so my mother became, over time, started as a secretary for him because I went to school with his niece, and they knew each other through, PTAs and stuff like that. She ultimately became the managing partner of the firm. She's not, and still is to this day, she is not a technical person by any stretch. If you ask her about tax rules or anything IRA or retirement related, she'll say, I don't know, ask my son. But she was great at dealing with people, could make great business connections, and helped see things through. And so ultimately she became the managing partner. I kind of grew up literally kind of in that office. And my standard line, I think, Michael, and you'll appreciate this as well as maybe some of our listeners, I always say, I knew how to roll over before I knew how to roll over. and so
that's hilarious.
And so with that in mind, I said, hey, I've been around this for a long time. This seems like something, I like finances, I like math, I like dealing with people and helping people. Maybe I'll go into financial advice. And it became a long and winding journey of starting down and seeing everything I did not want to do and all the ugly sides of this business, which was a little disappointing, but also a great eye-opening experience as to the dark side, so to speak, right? Of all the things you hear about that are bad and to happen, but then realizing that there is another way to go about doing that. And so over time, I ended up by happenstance, I had worked somewhere, figured out I didn't want to do what was going on there, and said, I don't know what to do. And I called up Ed and my mother, and they said, look, you're at this point, you're living, and I had moved to where this office was located at the time. And they said, we don't know that this person we have a friend who's close to there. We don't know that they're looking to hire, but they're a good financial advisor, probably willing to give you some tips to point you in the right direction. If you want to start your own business, or you want to seek out somebody who's more aligned with your, with your commitment to kind of put people first. And I went and I met the advisor, a wonderful, wonderful person. But when I called him, he said, I just can't meet you tomorrow. I have a book signing. How about we meet the next morning? And so we set the time to meet the following morning. I went the next day, though, to the book signing. I figured if this person's going to take an interest and be willing to take some time out to meet with me, I should at least be, interested in what they're doing. So I went, bought a copy of the book, introduced myself, and went home. And then I made the decision to do something that I do a lot to this day, just usually with tax law. I stayed up kind of all night and read the book. Yeah. And it was a great book. But here's the thing. I found these 4 or 5 like really esoteric IRA mistakes, like super in the weeds. No one really has any business knowing them. I know that at the time, but when I was reading them, I just thought, like, doesn't everybody know this stuff? So I called up Ed the next morning and I said, I'm going to meet this person. Do I tell him, as he's trying to help me, that there are mistakes in his book? And Ed said, no, there's no mistakes in this book. I know this person, 3+ decades in the business. There's no way. I said, I'm pretty sure that these are mistakes. And now, what? I later found out, he told my mom, like, your punk son thinks he knows more than these. So I ended up faxing them pages. And shortly thereafter, with slightly more colorful language, he said, son of a gun, you're right. Like, how do you know this stuff? And I said, Ed, I've been listening to you my whole life. Doesn't everyone know?
Yeah.
That led to Ed inviting me to New York and saying, would you come work with us for a little bit? We need younger talent. You clearly know some of these rules. I did that for about a decade, still scratched an itch, though, of wanting to be, in the spirit of direct service to clients. I wanted to have my own practice. And so I launched my own practice. That was more successful than I would have imagined very quickly, and led to me needing to take time out of Ed Slott and Company work. And to wrap up this story in a nice bow, once that happened, my good friend Michael Kitsis, who he reached out and he said, hey, I know you've got your own thing going on. Do you want to contribute to articles and stuff here on my website that is used to educate financial advisors? And I said, yes. Shortly thereafter, things were so good. He said, we should actually probably be at the same place together. we went and we said, where can we have the greatest impact on the community? And where would we want to be? And that led me ultimately to Buckingham and him as well. And it's been amazing since. The opportunity to work with folks like you who are impacting lives across the country has been awesome. And it allows me to do the thing that I enjoy the most, which is diving into the nitty-gritty and helping spread the word and getting information out to others who can then, like the scalability of this for me and the ability to, if I'm an advisor myself, I have the amazing opportunity to impact, 100, 200 families. But in this role as chief planning officer, I get to work with, several hundred advisors who each can go out and impact a couple hundred families. And so that it's been really rewarding.
Well, we're glad and thankful that you do, because we really do rely on your digging into the weeds and understanding those facts and uncovering those mistakes like you did in that book, so that we can benefit and ultimately our clients can benefit from that knowledge. So thank you. We can't thank you enough. With that in mind, let's talk about some of the things that are out there that may impact people's planning needs for this year. And there are a few topics that I want to touch on, and I don't want to get us too scattered, but I think about things like, we've had some legislation that may create opportunities for people for the rest of the year. There have been the elimination or the recent action that the Biden administration took around student loans that may have an impact for certain people. Sure. We have a down market, which may have created opportunities for folks with things like tax loss harvesting or maybe Roth conversions. We don't know, right? Mm-hmm. And we certainly have inflation in all the news. So I think there's a lot for us to grapple with, Jeff. And I'm going to throw it back to you a little bit. And given this environment and all these things that are out there, are there one or two topics that may rise to the top as you think about kind of the broad population of clients out there, things that we really should be paying attention to, given all this from now until the end of the year?
Yeah, I think there definitely are. And I would even take it one step higher and say that anytime there is uncertainty and which there certainly is now, and lots going on, the one thing I always encourage people to focus on is control the controllables.
Yes.
Now, there are things out there that are beyond our control, and we have to be willing to live with that. If you continuously make good financial decisions over a long period of time, that gives you the best opportunity at long-term success. Oftentimes people look and they say, like, what's the thing I need to do? Like, tell me the thing. And there oftentimes is, like, make this decision and it will be very helpful. But most successful financial plans and the most long-term wealth is not accumulated and sustained because of a single or even a small group of decisions. It's a series of good decisions over many years, repeated, and the best you can do is do the best decision you have with the information at the time. Okay. And so, to your point, right, there are things that we can do to control the controllables today, to make lemonade out of proverbial lemons, right? And certainly no one is saying, like, boy, I hope markets go down so that we can tax loss harvest, right? But if the markets are down like this, that is an opportunity. So tax loss harvesting would certainly be one. You mentioned Roth conversions. Here's the deal. I've gotten this question a lot this year. Should I convert because the market is down now? The answer to that is no, you shouldn't convert because the market is down. But if converting is right for you because it's tax efficient, doing it while the market is down is really a very strong move, because obviously the hope is at some point the market will recover. And if you have those recovered gains inside the Roth, this is the analogy sometimes they use is it's like paying tax on the seed and then reaping the harvest tax-free.
Yes.
So you can allow all that growth to occur inside the Roth IRA, which is incredibly powerful. And beyond that, looking at where things are with the market, this may give individuals an opportunity to relook at where they hold assets. So, many individuals, when we talk about the asset plan, they've done a pretty decent job at picking out their asset allocation, right?
Mm-hmm.
What do I own? The stocks, the bonds, the real estate, etc. Fewer have thought about how do they own it. Do they own it in a mutual fund wrapper, an ETF wrapper? If I want to own real estate, do I do it as a REIT? Like, do I go buy the Vanguard REIT, or do I buy my apartment next door and start renting it out? Both are owning real estate, right?
Right.
And very different tax attributes, because if you own your apartment next door, you get depreciation and you have QBI. I mean, there's lots of qualified business income that is, for those listening, a special break where you can get up to 20% tax deduction for that. But so there's different tax attributes, but then there's the final question. So we have, what do you own? How do you own it? But the last one is, where do you own it?
Where, right? Exactly.
And that's critical, like properly locating your assets. And many times what we see is people will come to us and they have improper asset location plans, not allocation, location. They've placed their assets in the wrong places, but because they've done it for so long and they have so many gains, the cost of fixing it is actually worse than just leaving it as it is. Like one of those things where you feel sick and you're about to take medication, but it's one of those medications that says, well, if you do this, you're going to have a headache, your arm's going to fall off, right? Like the symptoms, the repercussions are worse than the actual fix. Well, when markets are down like this and you've compressed your gains, in addition to just the opportunity to tax loss harvest, sometimes maybe it's not about the losses, maybe it's just about minimizing the gain. So the cost to switch your asset location becomes less expensive, and you can now make that correction and go on in a more efficient manner than before.
Yeah. It's such a good point, Jeff, and it's something that we have conversations with clients about all the time. Not only the asset location piece, but the impact of, and tactically how to take advantage of market highs and lows without practicing what we think of as market timing. You know, we're not really market timing, but we are taking advantage of the opportunities and the landscape that we're in, right?
That's right. We don't know what tomorrow will bring, but if we're looking at doing, let's say, a Roth conversion, I'd rather convert today if I was going to make that conversion than January 1st of this year. I know that, right? I don't know whether tomorrow I'd look back and say, boy, I wish I would have waited until today. But I know today it is better off to do that than to do it January 1st of this year. So even to your point, right, we're not predicting what the future is. We're just saying at this time, since we're going to do it anyway, this is an opportune move to make today. Whether it's the optimal time is yet to be seen, but it's better.
It's better. And we don't know whether tomorrow will be better or worse, but it doesn't matter. Let's get it done.
That's right.
Yep. Let's talk a little bit about inflation, because I think it's on everybody's mind. And I haven't
heard of that. Is that going on right now?
Yeah, exactly. What the heck is that? You know, I remember years ago, it's been so long since we really experienced inflation, of having to go through the exercise of actually showing people the postage stamp from 30 years ago, and you know, the actual physical example of this is what inflation looks like. Now we're really experiencing inflation in a way that we haven't for a long time. Yep. From a planning perspective, what are your thoughts about inflation and how clients should be thinking about it, and maybe what the planning opportunities are around that, or steps people might take? Again, I will caveat this a little bit by reflecting a little bit on what I think I heard you start to say early on, which is, I think as humans, we have a bias towards action, towards taking some action.
Yep.
So it may be that no action is actually the best solution. But with that in mind, what are your thoughts about inflation?
Yeah, so I think the very first thing I would point out is that markets still don't expect this to be a forever situation. And when I say forever, obviously not forever, but they don't expect this to be 8% inflation for the next 10, 15 years, right? They expect us to calm back down to, you know, in the threes relatively soon. And in fact, if we look historically at inflation spikes, such as what we're in right now, that is often what happens. There's kind of one notable exception, right? The 70s into the early 80s, where there was sustained, pretty significant inflation. And there's not to say that that can't happen again, but much more often what we see is a big spike in inflation, as we have seen recently, that is followed very quickly by almost like a shock to the system. Right? And again, quickly doesn't mean months. It could mean a year, 18 months, but in long-term time, it's relatively quick. And all of a sudden, that shock to the system says like, holy crud, I was buying, hamburgers at $3 a patty last week. And now, it's a couple months later and I'm buying them at $7 a patty. I'm not going to buy them anymore. I'm going to go do something else. And that kind of calms it down, again, relatively quickly, not a week, not a month, but usually you don't see long-term periods like this. And the market, to that point, does not expect it. If we look at long-term treasury rates, et cetera, they still remain relatively stable. They've ticked up, no question about it, but we're not seeing, 30-year treasuries at 7 and 8%, thank goodness. That would indicate a much more, that economists and the market predict much more sustained inflation. Now, having said that, look, we have the amazing ability to model things today that we couldn't in the past. It doesn't mean that we are predicting that that's going to happen, but we're able to model things differently. So, for instance, if someone says, you know what, that's great that you all think that, the consensus is inflation is going to be 3.2% over the next 30 years. But what if you guys are wrong? What if it's 5.5%? How would that impact my retirement? We can run that. We can do that. We have the tools. You have the tools at your disposal to tell to tell anyone looking today, how would that impact me? We can show you what that would look like. It's not to say we think it will happen, but we can illustrate that in a meaningful way. Now, clearly, sustained inflation in retirement is challenging. It becomes more challenging for some folks than others. Notably, the more you tie your income to dollars that are uninflatable, right? To dollars that won't change, the more you are susceptible to this. So, for instance, if you are a public worker or you have a private pension and you have a pension amount that is in static dollars, that is a challenge for you to a much greater degree than someone who perhaps held off and had a higher Social Security benefit. And you asked, what are some concrete steps we can take? Sometimes inaction is the best. Well, you're right. Sometimes that is the case. And but one solid step to consider is trading off dollars of your portfolio for holding off on Social Security, particularly for married couples. We're looking at the higher earner, right? It's much more important for the higher earner to consider this in most cases than it is for the lower earner. It's not that they're less important as a person, but the lower earner's benefit goes away at the first death. The second person, sometimes people say like, well, what if I wait till 70 and I die at 71? My first answer is usually, congratulations, you didn't run out of money, right? Like that was your biggest issue. You didn't have it happen, right? Yeah. But even in situations like that, there are scenarios where you could die having wait till 70, die at 71 day, never see $1 of your Social Security benefit, but your spouse lives long enough. Correct. And it still works out. And that is an inflation adjusted income. And if you compare that to commercially available annuities, or even building a ladder of TIPS, which would be kind of a similar type of risk element, there is such an advantage, particularly for individuals who are of a higher socioeconomic status and who have access to good healthcare, right? Again, this is not saying rich people should live longer. Wealthy people do live longer because they can afford and do go seek out medical advice. They tend to live more located in places where there's better access to health, facilities and so forth. So when we look at that, Social Security, the idea of taking at 62 versus taking it full retirement age versus taking at 70 is supposed to be actuarially equivalent, but Social Security is looking at everyone, not just the more affluent people who have longer life expectancies to begin with, and it's based upon interest rates that were in place back in the early 1980s. Not what's in place today. And so for all of those reasons, that's actually a very concrete step that individuals can take. And obviously, some in this call have already probably made that decision. Some may be years away from doing it, but it's just another thing to think about. And of course, looking at a fixed income allocation, there's a lot to consider there as well. For instance, sometimes as rates rise, your bond price may fall, giving you an opportunity to capture that loss, but then you can turn it back in to buy a bond paying a higher interest rate, effectively put yourself long-term in a neutral position, but take the loss up front. So there are all these types of things that we can consider very tactically. But the biggest thing I would say is don't panic, right? It seems like this is going to go on forever. And it seems like the market is kind of stuck in a rut. But that's oftentimes that old expression, the darkest night is right before the dawn. Yep. And I think that's probably a lot true here as well.
I think so too. And just as a reminder, first of all, a reminder to our listeners today, if you have a question, go ahead and enter it in the chat or in the question and answer. I'm happy to take your questions. And to your point, Jeffrey, we do, and we have been since this inflation has started to raise its head, for our clients individually, looking at their plans and modeling out different inflation scenarios, something we love to do and we do on a routine basis, just to back test it, just to go in and look, okay, what if inflation continues at a higher rate? How does that impact your plan? And everybody's plan is different. So it really is important to have an individual plan and really look at it periodically and really on an ongoing basis with your advisor to make sure that you stay on track no matter what. Well, let's talk about the legislation. And I know we had the Secure Act, which I think was last year, right? And there was a lot there. This year we had the Inflation Reduction Act, and I'm sure, Jeffrey, you're more on top of whatever else has passed this year. But let's talk about the Inflation Reduction Act and for that matter, any other legislation that you're aware of that's come along this year that may impact investors or clients that we maybe should take a look at some of those changes. Anything come to mind?
Yeah, I mean, certainly if we start with the Inflation Reduction Act, there are 3 areas of the law that I would say are fairly relevant for our listener base here. The first certainly would be the changes to Medicare Part B and D and drug prices. And there are a number of them. Without getting into the weeds as to exactly when and what changes are made, over the next, let's call it 7 to 8 years, a series of changes will be made to Medicare. First, that will limit out-of-pocket expenses and place maximum caps on that. We will limit the ability for drug carriers to increase their prices in drugs beyond what inflation is. And then the headline news on the Medicare is that over time, Medicare will begin to negotiate or be able to negotiate with drug companies for a limited number of drugs. At first, it will be limited to up to 10 drugs of Part D coverage. That's the prescription drug plan. Go to your local CVS, Walgreens, Rite Aid, whatever it is, and request it. But then over time, that number from 10 will balloon to 20, and it will also include Part B drugs. Now, most people don't think about Part B when they think about drugs, but there are certain things that are not not like prescription you'll go get at a pharmacy, but have to be delivered in, let's say, a medical setting, right? You have to get certain medication intravenously at a hospital, for instance. That would be under your Part B as opposed to Part D.
Part D.
Yeah. And so the hope, of course, is by negotiating, Uncle Sam will be able to use its significant buying power. I mean, there are a lot of people who are on Medicare, and largely it is the gold standard of healthcare coverage. I mean, if we think about this objectively, when someone retires at 60 and they lose their healthcare coverage from their employer, the first thing on their mind is, oh, I can't wait until I'm 65 and I go on Medicare, right? Everybody has that same sense.
Yeah.
So it is strong coverage, and this is just another one of those elements that will feed into that over time. So those are kind of the big changes to Medicare. Again, the hope is that will help to keep prescription drug costs in check and limit out-of-pocket expenses for folks. The second key change, I would say, related to the Inflation Reduction Act, which of course is abbreviated IRA, as if
I
we
love it.
make things more complicated. When you say, "Hey, have you talked about the IRA lately?" It's like, "Oh man, what are you talking about?" Yeah.
Right.
The second element is the change to the way the so-called Obamacare tax credits or the premium assistance tax credits work. So normally, once an individual hits 400% of the federal poverty line income, they're ineligible for any more credits. However, during the pandemic, that was changed. They increased the credit rate for those with more modest income. And what they said was that as income increases over the 400% poverty line, it's no longer a cliff whereby if you have 401% of federal poverty line income, you get nothing, and you get a significant credit at 400. It's not like that $1 now sends you off the cliff and you can't get anything. Instead, it's just phased out over time. You lose more credit as you have more income. And the reason that is meaningful is that for those who are getting insurance via an exchange, if you have kind of modest income, right? You're not at the super, you're not super modest income, but you're not a high income individual. Maybe you're in between, you've retired and you're in a gap year, or maybe you're taking some time off of work, whatever that may be. Whereas normally you wouldn't think about Roth conversions or selling stocks and having capital gains or any sort of control over your income. You wouldn't think about how that would impact your premium credits because you're not eligible for them typically. Now you may be, and by doing that Roth conversion or selling that stock or working that extra month or taking on that extra project as an independent contractor, you may in fact be increasing your tax rate, because not only are you paying your tax, but you may be phasing out, getting rid of some of that credit as well. So it increases the cost of that additional income for folks relative to what they would normally have. That's an important one. And candidly, Michael, that's where, consumers should come and sit down with you and say, how does this impact me? Right. Let you use, the tools at your disposal to analyze their income and project. This is one of those, you could try, but this is one where I would say, like, don't try this at home.
Don't do it at home. Yeah. Yep.
And then the last element here of the Inflation Reduction Act that I think is relevant and worth talking about is just the expanded energy credits, right? This is the very, very pared back version of the Green New Deal that everyone had talked about. And there are lots of credits in that for builders and for businesses to do green sorts of initiatives. But there are a few credits built into the law that also have a significant impact on end consumers, right? Folks who are listening today. So just a few of those would be new car credits, right? New energy efficient car credits. So a more significant credit for buying energy efficient vehicles, but there'll be some new strings attached to that, such as how much of the car is assembled in North America and where are the battery components sourced and things like that. But that could be a significant credit. A new credit for buying a used energy efficient car. So many people today are buying used cars, especially because there's still supply chain issues for new cars. I actually just got my own personal car. I ordered last October. Wow. I got it 3 weeks ago.
Wow.
Yeah. So, there's still supply chains with vehicles. So a lot of people are turning to used vehicles. We've never had a used vehicle credit. Now we will beginning next year. So, one tactical thing is if you're thinking about making a purchase, do you do it now? Or do you wait for that used car until January 1st of next year, when you could get up to a $4,000 tax credit for that purchase? So pretty significant. There are some income caps associated with these things and some other rules, but that is one element. There used to be a $500 home energy efficiency credit that people would qualify for, right? Like put in new windows, a new boiler, make some energy efficient upgrades. That's significantly increased to up to $1,200. And as many people who have ever explored the options for solar panels or things like that, there used to be, and it is a current 26% federal tax credit. That is going to be bumped up to 30%. So once again, you got to look at, will there be an increase in cost to putting them in next year? Will a lot of people wait? But maybe there's a benefit to waiting if you're thinking about doing that and doing it January of next year when your credit could be 4% higher than it is this year.
Yep. All important things to kind of factor into the overall plan and people's individual situations. Once again, planning is so individualized and really depends on each person's unique circumstance. When we look at all these different pieces of the jigsaw puzzle, as I always tell clients, that your plan is like a jigsaw puzzle. There's so many different pieces. We really need to make sure we understand each piece. Jeff, I know that that last year, I believe it was the Secure Act, correct me if I'm wrong, but there were some changes to inherited IRAs, and we have a lot of clients that are that have inherited money from relatives. You know, we are in the midst of one generation transferring to the next, and we're seeing it every day. And a lot of people are kind of scrambling, trying to figure out, gosh, what do I need to do before the end of the year to figure out, do I have to take everything out of this inherited IRA or a little bit out, or kind of what's that? That seems very confusing. Any wisdom to add about this inherited IRA business?
Sure. First off, it is confusing. And I know it seems like it's last year because everything has kind of crunched together. Yeah. The Secure Act actually was passed in December of 19, but we did get some, I know, right? It's amazing. It seems like it was yesterday.
Yeah.
Because it was right before the pandemic. And I always say, you know, right when that happened, people weren't worried about, you know, thinking about what happens to my IRA when I die. They were worried about, like, I don't want to die.
Right.
You know, so that became a more pressing issue. But what may be triggering kind of the late last year, early this year thoughts is that very early this year, we did get some proposed regulations on that Secure Act. And they do muddy the waters a bit. So for those wondering, like, what does this even mean for me? Well, the Secure Act made a number of changes to the rules for retirement accounts. But the biggest one that is most notable is, as Michael mentioned, taking what used to be the ability to stretch distributions for a beneficiary and compressing that schedule. So in the past, when an individual passed away and a living, breathing person inherited that account, a son, a daughter, a cousin, whoever, that individual was able to look at their lifetime and use their IRS provided life expectancy. So for argument's sake, a 40-year-old had about 45 years to take the money out of the account, which clearly would allow you to spread income over many years.
A long time to spread it out.
That's right. Keep taxes relatively low, benefit from the tax deferral offered by the inherited IRA wrapper. The Secure Act changes that for many, not all, but many beneficiaries to say, instead of your lifetime, you get 10 years maximum. And by the end of 10 years, it's like that old expression, you ain't got to go home, but you got to get the heck up out of here, right? That money has to leave the account by the end of the 10th year. And what you do with it afterwards is your own, you know, is up to you, but it has to leave the protected wrapper of the inherited IRA within 10 years. And that creates all sorts of planning complications, because if we only have 10 years to take money out, where before we had, you know, 30, 40, 50, 60 plus years in some cases, often with grandchildren, right? We have a much shorter time where that income is compressed into, which means we may be pushing people into higher tax brackets, meaning more money is lost to taxes. So what do we do, right? That's the big question now. What do we do? And there is what I call proactive planning here, and also what I consider crisis planning. And the difference to me is it mom and dad who are coming in and sitting down with you, Michael, and saying, what can we do to ensure our kids are not crushed with taxes? To me, that's proactive. Whereas to me, the crisis planning is when the beneficiary walks in and says, I just inherited this money, I'm going to get crushed with taxes. Now, admittedly, someone walking into your office and going, oh my God, I just inherited $2 million, what do I do? Is perhaps not the world's biggest crisis. But the point being, like, it's after the fact, there's limited options that can be done. If you're in that mode, crisis planning, the best thing you can do is just strategically time when you take that money out. So for some people, it's just spreading it out evenly over the 10 years. For others, it may be kicking the can down the road all the way until the 10th year, doing nothing the first 9 years and waiting until the end of the 10th year. And still for others, it's going to be finding the right time within that 10 years to spread income out. For instance, someone retiring at who's working and they're 61 and they're planning to retire at 65. Maybe they do nothing for the first 4 years, and then once they retire, they start to spread it out over the remaining years. Or maybe someone's 65, they're already retired, they have minimal income, but they know at 70 they're going to start taking Social Security, and at 72 they're going to take RMDs. Maybe for them, we front load it over the first few years.
Right.
Again, at the highest level, it's spread it out effectively, but that's it. Owners proactively have so much more options.
I wanted to just jump in because I think part of that you talked about there was clarification from the IRS last year, I think, which you alluded to, because there was some confusion, right, about whether you had to take it all evenly across the 10 years or whether you could wait until the end. And what did that clarification from the IRS provide? And is that settled at this point?
So the answer is it's not settled. We are still awaiting final regulations.
Mm-hmm.
The proposed, so one thing we know is it doesn't have to be even over the 10 years. There are one of two possibilities. Either it's just do whatever you want during the first 9 years and then get everything that's still left in there out by the end of the 10th year. Mm-hmm. Or another possibility is the IRS proposed that those who inherit from individuals who die prior to their required beginning date, which is a mouthful, right?
Yes.
Those who inherit prior to their required beginning date. So think about, I inherited from someone who died before starting to take their own required minimum distributions. They died at an earlier age. Those individuals would just have the 10-year rule like we talked about. Do whatever you want in years 1 through 9, take it out by the end of year 10. But those who inherited from someone who had already started to take RMDs would actually, under the proposed regulations, have both the old rules, which is minimal distributions each year over a life expectancy, plus the 10-year rule. So during years 1 through 9, you have to take the minimum amounts that you would have before this law. And in year 10, take whatever is left in the account.
Whatever's left,
Yeah. I don't know where the IRS is going to go with this. On one hand, if you read their reasoning for deciding that in the proposal, it's pretty sound. It's actually based on pretty good reading of the tax code. On the other hand, they have received a lot of what I would call hate mail in the form of comment letters, right? The institutions and providers and big think tanks have submitted comment letters to them saying this is a really difficult thing to implement. People already don't understand the rules. You're just adding even more complexity. Plus, for years, Michael, we've had this 5-year rule that applies to things like charities and estates, et cetera. Mm-hmm. It's always been just get everything out at the end of 5 years. There's never been RMDs in the interim. Mm-hmm. If you follow the IRS's logic on getting RMDs during the 10 years, you also would then have to impose that in the 5-year rule. And we haven't had that. And that rule has been there for like 2 decades.
Right.
So either the IRS has to admit they've been wrong for 2 decades, or they've got to find another way to interpret everything. And I'm hoping the latter is the case, just because it will make it easier to implement.
Yeah. So we'll wait and see. And for the time being, we do the best we can, and we help people at least understand that we need to work within a 10-year time frame, and we may have to take a little bit out along the way. So
that's exactly right. Yep.
Let's talk about the student loan business, because I think that affects a number of people. There's certainly, we have lots of people in our various communities that may have student loans, and this latest piece, I guess it's not legislation, but what do you call it? The president signed an order, I guess, and said this is what we're going to do. Give us a quick rundown about how that works and who's it impact.
Sure. And actually, it's great that we are doing this today because earlier this week, we got some additional clarification in the form of some FAQs released by the Department of Education. So at a high level, you're right, this is done by executive order. So we don't need Congress to do anything here, nothing. Like this is done. It's going to happen. And what the executive order calls for is really several things. We'll start with the forgiveness element, where up to $10,000 for most borrowers may be forgiven, and up to $20,000 of borrowers can be forgiven if the borrower received a Pell Grant. Now, Pell Grants are just that. They're grants. They generally don't need to be repaid, but they are typically issued to those in the most need of financial assistance. And so the reason we're referencing Pell Grants here, even though they're grants, is the Biden administration is just using that as the marker to say who deserves like extra forgiveness, if you will.
It's sort of a proxy for identifying maybe a less advantaged population.
That's exactly correct. Yep. Yeah. And so those borrowers would be eligible for up to $20,000. Now, there are income thresholds here, and those income thresholds relate to, interestingly, either 2020 or 2021. So if you have $125,000 or more than $125,000 of income in both of those years, and you're a single filer or you're a married person who files a separate return, then you're eliminated from this relief. If you are a married couple or you file head of household, married, of course, here being joint filers, and you have more than $250,000 in both 2020 and 2021, then you too are ineligible. But if your income is below those thresholds in just one of those years, it doesn't need both, but just one, you can qualify for relief. And the loans that are available for forgiveness are pretty significant. It's basically all publicly or federally held debt. So it could be direct loans. It could be a situation where there's a publicly held FFEL loan, which is a federal families. Oh gosh, I forget the acronym now. I think education loan. There we go. It could be even a parent plus loan. So parents who took out loans for their children, provided the parents are below the income thresholds, they too can have up to $10,000.
Oh, that's fantastic. I didn't realize that. That's fantastic.
Yeah. Yep. Yeah. So actually, in some cases, you could have up to $30,000 of debt for a student forgiven, right? If the student took out 10 or more and has 10 or more of their own debt, plus they received a Pell Grant, so then they could have up to $20,000 of their own debt forgiven. And then if the parents took out $10,000 of debt for that student,
or them,
all 30 could be forgiven. And the challenge, of course, is the opposite is also true, because it's all borrower driven. If a parent had 3 kids and they took out $10,000 for each kid, they are only eligible to have $10,000 of total forgiveness. Exactly.
Yeah.
One other important note, though, is that those who have privately held FFEL loans, that's that federal, that emergency loan program I was just talking about. This is a program at a high level where loans were issued, about roughly 10, 15 years ago or so. And during the financial crisis of 08, 09, the federal government purchased a lot of that debt off of the books of private institutions, but not all. So some of it became federally held debt, some of it remained privately held debt. And in general, this forgiveness only applies to publicly held debt. Well, what we found out earlier this week, they will allow refinancing of the private debt to a public loan and allow forgiveness of that debt, which is huge for those borrowers. And I got one more for you.
That's good. No, it's good.
I got one more for you. Part of the CARES Act, right, which was that initial pandemic relief that we had back in March 2020. That was the one that first started these, stimulus payments and all that. A lesser known part of that law was that if you made a payment voluntarily to a public loan, many people know that there's been a 0% interest rate and so-called forbearance, meaning you didn't have to pay during this time. But some people chose to do so voluntarily.
Right.
The CARES Act said any of those voluntary payments that you've made during this 0% forbearance period, you can request a refund of those dollars later. And so some people, let's say you had $12,000 of debt at the start of the pandemic, and you've taken advantage of this 0% rate, and you're now down to 4%.
Yeah.
Right? You only have $4,000 left to forgive, but you made all those payments. You can actually request the refund of those payments, bring your loan balance back up to the $10,000, which is your maximum forgiveness level, and then apply for forgiveness and have the $10,000 forgiven. So it is a home run. This is great for people's children and grandchildren. Get the word out to those folks. That is I hate to use the term free money because it's such a loaded term, but it's as close to free money as you're going to get.
It's true. That's pretty amazing. I didn't realize that. That
Yeah,
is
it's
pretty
awesome.
amazing. Yeah, that's pretty
And
cool.
and the application for forgiveness should be out sometime here, maybe early to mid-October of 2022, but you can submit all the way through the end of 2023. So it's important, and it's good to do so, sooner rather than later. But if you need to request a refund first to beef up your loan balance, so to speak, that's not going to be an issue. You can do that, get your refund, and then submit all before December of 2023.
That's good to note. And so there may be tax implications, or people may fear that there are tax implications. I know sometimes when other loan programs, when loans are forgiven, people get surprised because they get a tax bill and the IRS considers that income. What's the situation with these student loans?
So I'm sure people will be concerned about the potential for taxation. The good news is most people won't have to worry about that. At the federal level, that won't be an issue. There is current law that for the next few years, any student loan that is forgiven in this sort of fashion will be exempt from federal taxation. So that is an exception to the rule. You're right. Normally, canceled debt is considered income. Effectively, Uncle Sam says, well, you really kind of use that as income. We should tax you on it.
Right.
And so this is an exception to that rule. Most states either follow the federal rule or don't follow the federal rules, but have their own law in place that creates a similar thing where it will not be taxable at the state level. And of course, not every state has an income tax. There are, however, a small handful of states, I believe we're up to 3 now, where that will be taxable at the state level. So it is a significant minority of individuals, but it is possible that at the state level, there will be taxation of some of that student debt.
Yep. And I don't know off the top of my head, but I'm sure our CPA partners will know the rules for Vermont income tax in relationship to the student loan forgiveness.
Yeah, I'm pretty sure that is not, Vermont is not one of those states. I think Indiana may be one of them, as well as I want to say North Carolina was also in there. I don't believe Vermont was in there, but I will. Here we go: Mississippi, North Carolina, and Indiana.
Okay.
As of now.
So as far as we know, Vermont taxpayers should be okay for the student loan. But check with your tax advisor before you make a final determination. So with the time that we have left, I'm wondering, Jeff, as we kind of go maybe back up another 40,000 feet and just think about the landscape for the rest of the year and just sort of end of the year, or what I call sort of third and fourth quarter overall planning for clients. Are there topics that clients should be talking to us about, that clients should be thinking about, that we should be bringing to our clients for just end of the year consideration? Or anything come to your mind along those lines?
Sure. I mean, there are always things to consider here as we get towards the end of the year. So certainly we talked about some, such as looking at tax loss harvesting and Roth conversions and so forth. Oftentimes year end for those who are working is open enrollment period. So looking at what you want to do for the following year. Do you want to increase or decrease contributions to, flexible spending accounts and so forth? Certainly looking at, normally we'd want to look and see, do you need to use up your flexible spending accounts, things like that? Have you maxed out on retirement contributions? Also making sure at the end of the year, you've timed things appropriately. So for instance, if you took money out of a retirement account to use for higher education, well, you've got to pay that expense in the same year you take the money out of the retirement account.
Right.
Sometimes we see where people will take a December payment, or December, they'll take the money out of their retirement account. In January, they write the check for tuition. And that's not the same tax year. And all of a sudden, now you're back to the 10% penalty.
Yep.
So, making sure those things line up is absolutely critical. We get into Medicare open enrollment as well. And so one of the things people should always do is review their Part D coverage. I mean, you should do a lot of things, but that gets missed a lot. People just assume, well, my medications didn't really change from last year to this year. I don't have to do much. Just because your medications didn't change doesn't mean the drug plan is covering them the same way this year as it was last year. So a cursory check of the Part D plans that are available to you is a really important step each year to make sure that you don't end up unwittingly footing a much higher bill for prescription drugs down the road than you have to.
529 plans come to mind in our state of Vermont, where there is a tax credit available. But a lot of times we find clients get confused because you can contribute to your IRA after December 31st up until the tax deadline, but not so with the 529s and other things. We've got to get those in. So anything else like that you find people kind of get confused about the tax year versus the calendar year?
Certainly deferrals for 401ks would be up there. A lot of times people will think that they can do that after the fact. And that is you need to identify those deferrals by the end of the year. So that is particularly important. And of course, with retirement accounts, you do have that ability to go to April 15th for IRAs, Roth IRAs, HSAs, et cetera. But for those who are business owners, you may be able to push that out even further to September or October 15th if you're looking at qualified plans and such, so forth of that nature. So there are usually very few things you can do after the fact to change your income at the time. And look, classically, we always look at the end of the year. Should we push income or pull income? And should we push deductions or pull deductions? Effectively, if you think your income tax will be higher next year, pull the income forward this year. If you think your income will be higher or income tax rate will be higher this year, push it forward to next year. Same thing with deductions, but the opposite. If you think you're in a higher rate this year, your deductions are more valuable. Or it could even be that you need to bunch your deductions to get above the standard deduction. Right now we're in a situation where very few people have the ability to itemize. It's less than 10% of taxpayers today itemize because the standard deduction is so high. So simply looking at those things. And I'd be remiss if I didn't mention required minimum distributions, right? A year-end requirement there. That's another one where you can't put that off until April 15th.
Right.
Provided, assuming this is not your first year of RMDs, that has to be done by December 31st, along with things like withholdings and estimated tax payments, all should be reviewed before the end of the year to make sure you're putting yourself in the best position that you can for you and your family.
All great points and all important agenda items for us as we meet with clients between now and the end of the year. We've got a couple minutes left, Jeff, so I'm going to ask you to dust off your crystal ball. There have been a couple of topics that over the last few years we've been wondering about. One has been, oh my gosh, is the capital gain rate or the tax rate on capital gains going to go up in the future? And the other one has to do with what we call backdoor Roths. For a little while, we were worried we were going to lose that. And now we think that's still a strategy that we can use. But so in terms of the rates on long-term capital gains or the kind of whether we keep or lose the backdoor Roth, how cloudy is your crystal ball?
Well, provided Congress stays in a similar makeup as it is today, I think capital gains changes are off the table. Of course, we're coming up on a midterm election here, and it's going to be a very interesting midterm election. On one hand, the economy is not working in Democrats' favors. On the other hand, there are several social issues which seem to be giving them at least some momentum. So it will largely depend. I mean, there's the old, it's the economy stupid, line. We'll see which kind of prevails in the midterms. If Democrats can pick up significant number of seats in both the House and the Senate, they may be able to advance more progressive tax legislation than they can given the current makeup of Congress. I think that's still it's still something they'd like to do. There's just not the votes to do that at this point. And they're certainly not going to do spending, significant spending bills right now, given the inflationary issues at the time that we have.
Right.
So I think that's possible, but it would require significant change in Congress. As far as the backdoor Roth, that I don't think it will happen, but I do expect there to be a retirement bill here towards the end of the year And I actually expect it will pass in a lame duck session of Congress. Effectively, we talked about Secure Act. We can consider this Secure Act 2.0, as it's commonly referred to as. This would be a bill that would potentially push back required minimum distributions even further to age 75 for individuals, would create potentially some new Roth types of accounts. The Senate just was working on their version of this bill this week, in fact, and they will now meet with the House, which passed its bill overwhelmingly, more than 400 votes yes, which never happens anymore, right?
Yeah.
So there is broad bipartisan support. It's possible that they could sneak that backdoor Roth prohibition into this bill, since it's a retirement-related bill. I wouldn't predict that, and I think it's probably less likely than not, but it is possible. I will say, though, I do think the bill will pass, and I do think we'll see a age 75 RMD age here, not today, but pass soon for the future. And if I was a betting man, I would say in a lame duck session of Congress this year.
Interesting. Well, Jeffrey, thank you so much for your time today. We covered a lot of ground, a tremendous amount of ground. Really thankful for the insight. We'll have to get you back another time to talk about Social Security and lots of other topics in the future. In the meantime, thanks so much for your time. Thanks, everybody, for joining us. Next month, we're going to be talking about, I'm going to have my friend Jared Hoffman on. We're going to be talking about cybersecurity and scams and hacks and how to keep yourself safe in the ether that we all live in these days. So thanks, everybody. Have a fabulous rest of your week, and I'll see you next month.